Hello and welcome to On the Couch with Steve. This is a podcast where we help you navigate the world of buying and selling real estate. Obviously, I'm Steve Athanates. I'm the owner of NG Real Estate here in Ipswich. Today, very, very exciting. We are talking about interest rates. We're sitting here with Steve Beach from Stanford Financial. Welcome back, Steve. Great to have you back on board.
Well, get back.
Now, we've just had the announcement. We're recording this about an hour after the event. We've just had the announcement from the Reserve Bank. Steve, what happened?
Well, as we sort of probably predicted last month,
We did predict it.
Rates still went up. I thought they would have put it on hold. Like we said, there was a lack of information that they didn't have the full idea of what actually is happening with the economy. So although they did announce today that they believe we have peaked in inflation, it went from 7.8 down to 7%. So it's a massive drop, which everything is heading in the right direction, exactly what they wanted to do. Biggest thing still, consumer spending still quite high. Immigration into Australia was a big decision factor in that as well. So there's a lot more cash coming into the country, which is also increasing where it's not steadiling that inflation as fast as what we like.
So what we're seeing an increase in migration that's now impacting on the economy because these people have got money. And they're prepared to spend it.
That's it. Yep. And also, again, it's also starting to push up a little bit at the rental market. I heard the last podcast we're talking about rents and everything along those lines. So there's more people coming into the country. Ultimately, initially, a lot of them can't buy houses until they sort of get residency here and everything along those lines. So they're in that rental market and I guess competing against everybody else at the same time.
All right. So interest rates went up by 0.25% today.
Yep.
Official cash rate is now...
So it was 3.6, it's now 3.85, which is where a lot of the banks did actually predict that we were going to end up at 3.85. But they were also predicting that probably by August. So I guess we've hit that milestone. Whether or not, I know there was a few people talking, have we seen it? Phil Lowe definitely did not hint that we have seen the last of the rate rises. If the economy still is strong, he will potentially have to lift rates again in the future. But at this point in time, since you had probably 9 out of 10 banks and economists predicting that rates were going to hold today and they went up, it's probably a good indicator that the next movements should be if not the stabilising at no rate changes until the end of the year, where potentially
we'll talk about your prediction at the end see if we get it right again next month. But we'll talk about that at the end. Now, the Reserve Bank has minutes of the meeting that they've had today. When do they release those minutes? Because that's when we tend to get an indication of what they're thinking.
So that gets released at 2:30 on the day of the announcement. So we've sort of siphoned through them and again, sort of talking and alluding to exactly what they sort of talked about last month. So the inflation figures, I guess, again, talking about what's happening in global economies around the world as well. So we're actually doing it a lot better than a lot of the other countries outside of Australia. So we're still seeing inflation increasing in exponential in other countries around the world, is where I guess the RBA although we may not feel like it's the right decision, but with all these sharp rate rises, Australia is definitely lining up to be in a lot better financial position than a lot of these other countries at the moment.
Now, what happened overseas? Since our last podcast, we'd obviously seen some institutions go belly up in the US and in Europe. Has there been any further developments on that?
Not really. There hasn't been too much of a change, moving factors that way. But I guess a lot of it to do with the cash rate and movements in Australia, and particularly in the mortgage market, which is what I sort of base it on. If you look to America, where they sort of fix the rates for the life of the loan. So essentially, they take out 30-year fixed rates. As we're here in Australia, we only go up to 5 years in fixed rates. So 1, 2, 3, 4, 5. Predominantly, we find most Australians are actually sitting on variable rates. And this cash rate actually will predetermine and move our, I guess, repayments on our mortgages up and down based upon, where the cash rate is situated. So I guess they're moving of the cash rate in other countries, it doesn't have as, much of an impact as what we're seeing here in Australia, with the fact that we've got more than 50% of borrowers on variable rates.
I'm going to be honest, I had no clue that in America it was a 30-year fixed rate. It's quite bizarre, really, isn't it? And it's great for them, like you said. So even if they do get a 1% rise, is it then fixed for the life of the loan, or if it comes back down, does it
doesn't move. So once you set your repayments over there, it's set. So essentially you see probably a short-term fixed rate over there would be sort of 10 years, but most of them are just fixed for life. So that's what your repayment is from there. And then keeping in mind, we also talk about, second mortgages and third mortgages and stuff like that. So there's people that they have their set mortgage and then ultimately they'll do a top up like we do. But generally here in Australia, we'll chop and change. We'll go from one bank to another. Yes. Over there, they sort of fairly regimented and they'll just stay with the one bank.
Right. Okay, interesting. Now, obviously, I know there's been some new developments with the federal government and some of the schemes that are on offer, in particular first homeowners and things like that. So you had some fairly interesting information that you wanted to share with everyone today.
So I guess announced only just recently is the government is extending the first home loan deposit scheme that they've been running. So that was a Liberal government intervention, which is that you only need 5% deposit and the government will guarantee the other 15%. So that's now going to continue on into next financial year because they always finish on the 30th of June.
Yep.
So this comes into effect as of the 1st of July. So they're essentially loosening some of the rules. So it was for only Australian citizens. Now it's reduced down to permanent residents of Australia. So it opens up to a lot of other people that have come to the country but haven't chose to go and become a citizen. Also, they're changing some of the rules where you don't necessarily have to be a first home buyer. So as long as you haven't owned a house in 10 years, you are now considered eligible for that 5% deposit scheme. They've also opened up, which not a lot of people know about, is there's the first home loan deposit scheme. There's also what they call as the family home scheme, which means if you're a single parent, so an adult with a child, you actually only need 2% deposit and the government will guarantee the other 18%. And they've actually extended that out to legal guardian with a child. So whether, if a grandmother is
the legal
guardian of a child, they are now eligible for that family home guarantee. So you don't have to be a first home buyer, just as long as you're a single parent.
No, and you also told me off air about some developments where you don't need to be in a relationship.
Yes.
You can, like two mates could buy a house together.
That's it. So it used to be under the first home loan deposit scheme again, or these schemes, is that it was generally considered a couple or, married or de facto. Now it's opened up to two mates, two brothers, sister, mum and son. So literally any two parties can come together as long as they've got that 5% genuine savings, can be part of that government eligible scheme.
So for them, they either have to be first homeowners or they have to have not owned a house for 10 years.
For 10 years, yeah.
So even too, I guess this is really important. I guess there's some people out there who have been in the rental market for an extended period of time. Now, at different times, we obviously went through the global financial crisis in 2008. Now, some people, unfortunately, lost their house in 2008 and then may have been in the rental market ever since. Now, for those people who obviously suffered really severely through something that was generally not speaking their own fault, they're now, it's well over 10 years since that event's occurred. Those people can now come back and say, hey, I've been good, I've been saving hard. I want to buy back into the rental market and I want some government assistance, and they can get it.
Yeah, definitely. And we're seeing it at more and more. This is going to help a lot of those people moving forward. But even just recently, we're still getting a lot of people where they're getting been renting for a while. Their parents are now retired and got come into some money, and they want to gift their child some money to help them get into to buy their own home. With a gift letter from mum and dad and a rental ledger, you essentially need zero deposit as long as mum and dad can front you that first 5% and you've been renting for 6 months. A lot of the banks out there can actually still put you through that first home loan deposit scheme.
Look, and wow, I think that's really exciting because for a lot of the parents out there, this is probably their number one fear, is they're thinking, well, how are my kids going to afford to get into the property market? How are they going to save in an environment where everything's just getting dearer and dearer and dearer? How are they going to save a 5% deposit? So you're now saying mum and dad get to the end of their working life, they've saved hard, they've obviously got money in super and all those sorts of things. They can now say to kids, here's your 5%, just show us your rental ledger, that, and away they can go.
Away they go, yep. And if you think, it's still a lot of money, but you think on a $400,000 or $500,000 purchase, 5% of 400,000 is 20 grand plus probably a 1,500 to 2 grand in legal fees of stamp duty transfers and stuff like that. So for 22 grand or 23 grand or even I've recently had a client sold their car because the car market's gone up just as fast as the housing market. Sold their car, was renting, so they sold the car for 25,000, went and found a house for 460,000. They had the 5%. So just from the sale of an asset.
Wow. All right, so with those people who can get into the market, their situation, do they still pay stamp duty if their purchase is less than 500,000?
Only for your first home buyers.
So this is still maybe someone who hasn't owned a house for 10 years?
No, so that they haven't come through and announced any sort of stamp duty concessions for previous. But ultimately, by buying a house under 500,000, you still get the principal place of resident stamp duty concession, which is, roughly speaking, right now, don't hold it to me, but I think it's $7,250 is your discount off your stamp duty by buying it as your actual place of residence.
Principal place of residence. And look, let's face it, $7,000, it's nothing to sneeze at. It's a fairly great sort of leg up into the marketplace. So absolutely fantastic. Any other news in the finance world that we need to know about?
Not at this stage. I suppose if you were CBA, you'd be rooting and tooting because you're the only one that actually predicted the 2.5, other than us.
Other than us.
Of course.
We said it here last month. We told you. Kudos, Steve. Well done, brother.
But yeah, so no, not anything really drastic. But again, like I said, I think we're at the peak of, well, definitely at the peak of inflation. So we're definitely going to see a decrease there. I guess in regards to potential rate rises moving forward, the biggest, scariest market is EFS, so end of financial year sales. There are a lot of consumer spending. Like, we spend almost as much money in June as we do in December. So I guess it's whether or not we can sort of hold back buying those new TVs and PlayStation 5s and bits and pieces to see if we can keep those interest rates stable where they are. And then ultimately, as everyone's sort of predicting at this point in time, maybe even as early as December, we may start seeing some of these rate cuts come through, but definitely into 2024. I think they will start to reduce rates again because inflation is definitely teetering down. What they don't want to do is essentially fall it so far that we fall into an actual recession. What we need to do is essentially a soft landing of, yes, sharp, what we've sort of come through, but I guess the target inflation rate is between 2 and 3%. They're anticipating that it's going to be 4.5% by the end of the year, and then down to sort of 3.5% by 2025. So, again, it's a 18 months to 2 year, sliding scope that they're looking at. So it's not just now; it's what the economy is going to be looking like in 18 months' time as well.
Awesome. Now this is drum roll time. This is prediction time, boys. You tech boys, drum roll time. So, what's going to happen next month? Now, bearing in mind, let's say everyone's naughty and we start buying cars and all sorts of things and doing all sorts of weird things, spending money. Inflation doesn't drop come the next month. Okay, what if it rose? Like, if it actually went to, say, back to 7.2% or something like that, what happens? And generally speaking, if it doesn't rise and even if it doesn't go down, what's going to happen next month?
Again, this is, debatable. I personally don't think rates are going to rise next month. I'm probably with NAB, who was predicting a sort of August potential rate rise. With the fact that it's risen today, with the statistics that's actually come out that's a little bit lower than what we're anticipating. GDP is really going well in Australia. We've also, I guess moving forward, I still think rates will hold next month. I think... Let's see how we go for June's inflation data for the
Well, I think that's the telling factor. I'm going to jump off the fence. I'm going to tip against you. Okay, you're saying they're going to go on hold?
Yes.
Just to make it interesting, I'm saying we're going to get one more little kick in the backside and just hopefully that may be the end of it. Because I'm concerned if we don't get another one, maybe people's habits don't change enough, and then all of a sudden we end up, instead of getting one more, we might end up with 2 or 3 more. So I think you're right overall about what's going to happen towards the end of the year, but I'm tipping we might get one more.
I guess we're probably predetermined with what happens with unemployment as well. So unemployment's still sitting at a 33-year low.
Low, yeah.
So we're less than 1.5% unemployment in Australia at the moment. So we're the horrible thing to think about it, but the target rate is sort of between 3 and 4% as well. So if that slowly increases, then rates won't move. But if we're still sitting at a sub 1.5, you may be on the money there, and I'll owe you a beer.
Okay, happy days. That's really excited me. Now, before we finish off, I think it's probably only fair we give some kudos to the Australian government. Like, at the end of the day, you're saying compared to the rest of the world, we're actually faring pretty well.
We're doing very well. Fears of recession and all that kind of stuff, which is what a lot of people were concerned about with these sharp rate rises, is that we would fall into a recession. But GDP's strong. So essentially the Australian economy is doing really, really well. Yes, it's too high as far as CPI is concerned, but the RBA is doing the right thing. There's probably, me as I have a mortgage. I don't want to see rates go up anymore at all. But
I don't either. I'll say that. I don't want them to go up.
We want to see them go back down.
No one does. We want them to go back down and obviously take some pressure off people with the cost of living, because it is really quite severe at the moment. But you keep going.
But yeah, so as I was saying, like Australian economy is definitely stronger than most out there in the rest of the world at this point in time. So with America still, they're still in growth rate at the moment, where they need to be dropping.
They're still printing money too, aren't they?
They are definitely printing money. One thing that we haven't had to see yet. I guess big thing, and probably something we'll talk about on the next podcast. Next Tuesday is the budget from the federal election. So
sneaky tease, I like it.
So
sneaky tease.
So we'll see what comes out of that. That'll probably have some weight bearing on next RBA announcement as well, depending on what sort of government expenditure they're going to look at doing as well. So that's probably going to be a big thing.
Well, I think they're going to spend money, because obviously all these new incentives, they're showing that they're concerned about the amount of houses that are available for people to either rent or to live in generally. So they're trying to stimulate that marketplace.
Well, they're talking about producing, I think it's 7,000 new homes for people that are in financial hardship and everything, also like your community living. So, the government can't control the supply of houses. They can control the demand. A big thing moving forward is I know there's a lot of talk, particularly from the Greens, in regards to abolishing negative gearing effects for investment property holders. Whether you like it or you don't like it, the only concern I have with that is if you abolish negative gearing, it's only going to push people who own investment properties to raise the rent higher, because if they're not going to be negatively geared, they want them to be positively geared. So rent's only going to continue going up. So maybe instead of de-incentivizing the property owners, incentivize them to drop the rental prices and give them more tax relief at that tax time. So,
well, even if they did that, the only choice the government then has is they have to build a whole heap of public housing, because there won't be enough houses.
That's it.
So even if they take away the tax deduction, they then have to foot the cost of building all these new homes themselves.
That's it.
Which means the taxpayer, you and I, would have to pay for it. So yes, let's not hope for that. Now, we will obviously talk next month about what happens with interest rates.
The flip of a coin.
So they're up 0.25%. Cash rate is 3.85%. You think they're on hold?
I think they're on hold.
I think one more, unfortunately, maybe one more time, but we'll see what happens. But thanks for tuning in and to hear and see more of what we're talking about on the couch with Steve. Please subscribe below. You won't regret it. Special thanks, as always, to our special guest here, Steve Beach from Stanford Financial, doing an amazing job. Need a loan. This guy over here. So if you have any opinions about what we've talked about today, please don't be shy. Reach out. Tell us what you're thinking about the content of our podcast and I guess the relevance of what we're talking about. We'd really love to hear from you. So please stay tuned for more on the couch with Steve.